I've been reading a lot about insurance cuts. Does the Fed really need to cut rates with interest rates rather tame, but certainly not acting as though they're not pegged about right? And inflation is low, but not real low. Does the Fed really need an insurance cut at this point, Michael?
I would say absolutely not. The economy has slowed from its very aggressive levels that we had in the third and fourth quarters of last year. But the ISM data is coming off the peaks. It's not clear that it's going to fall much further. It's all in expansionary territory. Growth is solid. Inflation is low, but it's not likely to keep going down. So everything actually looks very good right now. And the insurance cut, I think, is not appropriate at the moment. But down the road, depending on how the economy behaves, we'll see. But for now, I think everything is in good shape.
You know, we've taken our eye off the crisis era ball, and we're now more viewed into getting more normal with regard to monetary policy in our central bank. But let's change our focus again. You know, crisis era management, quantitative easing, we still have a whole lot of securities, even though it's not as many as we did have. We now have interest on reserves, which, by the way, is 2.4%. I guess my question to you is, have we stopped paying attention to how odd that arrangement really is? I mean, for people out there that are looking to borrow money, start a business, it certainly seems though we've handicapped the banking system by taking a lot of their seed corn, paying them 2.4%, and kind of taking it out of the game. Your thought?
Well, part of that is exactly true. They pay an interest on reserves at a competitive rate. It keeps those excess reserves at the Fed and not sloshing around the economy, so it doesn't fuel excess credit growth.
Wait, stop, Mike. I want to interrupt you here. So if the president and Kudlow and Kramer and so many people think they have to ease because it's not white hot enough, wouldn't that be a good way to go? Dump some of those reserves into the system?
Well, I think the level of interest rates is also very important as opposed to the amount. I don't think most banks are talking about a shortage of capital, shortage of balance sheet to lend more money. They just don't feel the inclination to lend more money because there's not enough demand at their price point to lend at this point in time. The level of interest rates in terms of nominal and real terms are quite reasonable levels in order to encourage financial and economic activity.
My final question is, there's a lot of agita, of course, about what other central banks are going to do. I really do believe, as Kovacevic was just speaking, that other central banks are our biggest risk. We only have a few seconds left. There is no way I can see to mitigate that from the viewpoint of the Fed, is there, Mike?
No, the U.S. is situated in a global economy, and this global economy is not performing all that well these days. And other central banks have pivoted to an ease faster than or as farther than the U.S. has pivoted, which has created a backdrop of a stronger dollar environment and a constraint on Fed action.